Have you ever considered how profound financial upheavals, like those seen in past banking crises, can completely remap the regulatory landscape, fundamentally changing how our financial institutions operate and are overseen? Following the devastating savings and loan crisis of the 1980s, the United States government enacted sweeping legislative changes, primarily through the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. Known as FIRREA, this landmark act dramatically restructured the regulatory framework for thrift institutions, aiming to prevent a recurrence of such widespread failures. The crisis itself was a complex tapestry woven from several contributing threads. Deregulation in the early 1980s, notably the Garn-St. Germain Depository Institutions Act of 1982, permitted savings and loans to expand beyond traditional home mortgage lending into riskier commercial real estate and junk bond investments. Simultaneously, a period of high interest rates meant that these institutions were paying more to attract deposits than they were earning on their existing portfolio of low-interest, long-term mortgages. This created an unsustainable interest rate mismatch. Adding to this was a significant moral hazard problem. Deposit insurance, intended to protect depositors, inadvertently encouraged S&L executives to take on excessive risks because their depositors faced no direct consequences from their speculative ventures. The Federal Savings and Loan Insurance Corporation, or FSLIC, the government agency responsible for insuring these deposits, quickly became insolvent, unable to cover the mounting losses. FIRREA addressed these issues by fundamentally overhauling the system. It abolished the Federal Home Loan Bank Board, which had previously regulated savings and loans, and transferred its oversight responsibilities to the newly created Office of Thrift Supervision, or OTS, within the Treasury Department. Crucially, it established the Resolution Trust Corporation, or RTC, a temporary government entity tasked with managing and disposing of the assets of failed savings and loans. The act also significantly tightened capital requirements for thrift institutions, making them more resilient to economic downturns, and greatly expanded the supervisory powers of regulators, enabling them to intervene much earlier and more decisively when institutions showed signs of distress. The reforms introduced a much more robust regulatory framework, emphasizing stricter capital adequacy and more rigorous supervision. This shift moved away from the prior lax oversight that allowed so many institutions to fail. Furthermore, the sheer scale of the cleanup, estimated to have cost American taxpayers over $160 billion, underscored the critical need for a strong, centralized regulatory presence. This crisis also brought into sharp focus the concept of systemic risk, highlighting how the failure of numerous interconnected financial institutions can threaten the stability of the entire economy. Understanding these profound regulatory transformations illuminates how historical financial crises act as powerful catalysts for reform. The changes implemented after the savings and loan crisis demonstrate a critical evolution in financial regulation, reinforcing the importance of sound capital standards, vigilant oversight, and effective mechanisms for resolving troubled institutions, all designed to safeguard the integrity of the financial system and protect public funds against future systemic shocks.